Welcome back to the deep dive. We've been digging into Schumpeter's The Theory of Economic Development, and last time we really focused on the who, the entrepreneur.
Right, that figure who shakes things up, disrupts the equilibrium, the circular flow, by bringing in new combinations, innovation.
The agent of creative destruction.
Yeah, it's the engine driven by, ambition, the joy of creating something new. But it's not just about willpower. They need actual stuff.
Stuff like land, labor, materials, machines. And that brings us squarely to Chapter 3, our focus today. Because here's the puzzle Schumpeter sets up. If the economy's in this perfect balance, the circular flow,
Where everything's already working efficiently.
how does our entrepreneur, who hasn't made anything yet, get the power to pull resources, that skilled labor, that factory away from their current stable jobs?
Yeah, how do they muscle in? And that's the shift. We're moving from the person to the financial plumbing. Today is all about Schumpeter's, frankly, radical answer: credit.
We're diving into what he himself knew were kind of heresies about money and finance.
Absolutely. Showing how finance isn't just a mirror reflecting the real economy, but the actual engine, the thing that makes development possible.
He basically says innovation can't happen without a financial system willing and able to create purchasing power specifically for disruption. It's a huge idea.
It really reframes what we even mean by a capitalist economy. So let's start with that core idea, the circular flow. Development isn't just more of the same, it's different, a different use of existing labor and land.
Right, like replacing horse carts with an electric railway. You need the workers, the iron, the land, that we're doing something else.
And to get them, you need to bid for them. You need purchasing power, which crashes right into two big heresies Schumpeter throws down against the mainstream economics of his day.
The classical view, mostly.
Exactly. Heresy number one attacks the idea of neutral money. For ages, thinkers like David Hume onward said money is just a veil.
A lubricant, maybe. What happens with money just reflects what's happening with goods.
Yeah, the real factor is labor, capital goods. They determine production. Money just set the overall price level, nominally.
But Schumpeter says, hold on. For development, for this disruption, purchasing power is crucial. It's the vehicle for the process.
It has to be. When the entrepreneur needs to grab those resources, they have to inject new purchasing power. And that act directly messes with the existing balance.
How so?
Well, if I, the innovator, suddenly offer higher wages for mechanics because I have new funds, I'm reducing the real buying power of the old buggy maker, who still needs those same mechanics but can't match the price. Money isn't neutral there. It's a tool of reallocation. It starts the disruption.
That's a big departure. The financial act causes the change. It doesn't just follow it.
And that leads straight into heresy number two. That means of payment, specifically things like bank credit, get created and do the same job as physical money.
This wasn't totally unknown, technically, right? Bankers knew they created credit.
They knew the mechanics, yes. But economists often kind of glossed over the implications for development. Schumpeter zeroes in on the economic significance. This proves the system can generate the leverage needed for change.
Okay, let's play devil's advocate. Why can't the entrepreneur just borrow the goods directly? You know, go to the steel mill, promise them a share of future profits for the steel they need now.
Schumpeter tackles that head on. First, remember the circular flow, equilibrium. By definition, there are no idle stocks. Everything's already allocated.
So the steel meant for buggy wheels can't just be diverted on a promise. The steel mill needs payment now to keep its cycle going.
Precisely. And even if they could get existing goods somehow, they'd still need purchasing power to buy them. But the bigger issues are timing and risk. Steel producer, the landlord, the worker. They cannot and will not wait for his return. The entrepreneur might succeed, but maybe not for years. The suppliers can't carry that risk.
And the entrepreneur can't pay workers with food and shelter they don't have yet.
Exactly. They're starting from scratch. If they buy consumables to pay workers, they're back to square one, needing purchasing power.
So the whole process demands getting resources now and paying back later.
That gap, that chasm between needing things and having produced things, only credit can bridge it. The structure of the problem demands a financial solution.
Which forces the conclusion.
The entrepreneur must be a debtor. They are the typical debtor in capitalist society. They take from the economy before giving back.
They get an advance on the national dividend, so to speak, without the usual claim.
Which is why Schumpeter defines credit functionally. It's that essential temporary transfer to him of purchasing power needed to be able to carry out his new combinations to become an entrepreneur.
It's the precondition. The lack of spare resources necessitates creating new buying power.
It's an incredible idea, really. The system essentially trusts someone with resources based only on a promise about the future. It's not about saving up first. It's about commandeering resources through finance.
Okay, so this credit is essential, but Schumpeter's very specific about what kind of credit. It's not just borrowing existing savings, right?
Absolutely not. He draws a very sharp line. There's credit that just mobilizes existing wealth, moves it around, and then there's the credit that matters for development, the creation of totally new purchasing power.
And this links back to that technical point about banks.
Yes. The fact that banks issue more credit, more claims than they could possibly redeem in physical cash all at once. These bank credits are newly created side by side with the existing sums.
And it's this power to create out of nothing ex nihilo that Schumpeter sees as the key mechanism.
It's the core of the banking function for him. Banks aren't just intermediaries pooling savings. That view that they just lend other people's money misses the point, or it only covers part of what they do.
So if banks only lent existing savings, that money would still be tied up in the old circular flow.
Right. It would just shift ownership, maybe. But it wouldn't necessarily pull resources out of existing uses into new ones. It's the creation of new claims, new demand, that gives the entrepreneur the power to bid resources away.
That's why the bank's fundamental role, in this view, is enabling development.
Exactly. The creation of means of payment centers in the banks and constitutes their fundamental function.
Now, to really get this, we need that distinction he makes between different types of credit. Let's talk about normal credit first, Betriebscredit. Why does he call this unessential for understanding the dynamics?
Okay, Betriebscredit is basically working capital credit. It's for established businesses within the circular flow.
Like covering payroll until your invoices get paid.
Precisely. In the pure model of the circular flow, production finances itself. You sell goods, you get money, you use that money for the next round. Betriebscredit just papers over temporary timing gaps between payments and receipts.
So it's a practical convenience. If everything's synced up perfectly, you wouldn't even need it. It doesn't change what is produced or how.
Right. Schumpeter says for analyzing the circular flow, you could just imagine everything uses metal money that exists once and for all. It helps isolate the truly dynamic credit.
Which is the abnormal or essential credit, the credit for innovations.
Yes, this is credit created ad hoc. It's not backed by existing products or savings. It's backed only by the future goods the innovation is expected to create. This is the entrepreneur's specific financial tool.
This seems like the perfect time for that key quote you mentioned, the one that really defines this type of credit.
Yes, it's crystal clear. He says, credit is essentially the creation of purchasing power for the purpose of transferring it to the entrepreneur, but not simply the transfer of existing purchasing power.
Not simply the transfer. That directly contradicts the standard loanable funds idea, where savings drive investment.
Completely. Schumpeter is saying the purchasing power is manufactured for the specific purpose of bridging that innovation gap.
It's like a temporary financial bridge built on future expectations.
He puts it beautifully. Credit temporarily substitutes, as it were, a fiction of this claim for the claim itself.
A fiction, wow.
And it acts as an order on the economic system to accommodate itself to the purposes of the entrepreneur, as an order on the goods which he needs.
An order on the economic system. That's powerful language. It's like the bank, by granting credit, gives the entrepreneur a special voucher that says, give this person the resources they demand now.
And without that mechanism, think about it, how would any major innovation get off the ground if it needed resources already locked into established uses? The time lag would kill it.
So credit creation is the economy's way of placing a bet on the future, on disruption.
And the banker is the one placing the bet, essentially underwriting the entrepreneur's vision. They're saying, I believe your future output will validate this purchasing power I'm creating today. It's a crucial act of enabling innovation.
Okay, we've got credit as the how, the financial tool. Now, Schumpeter uses this to completely redefine the what. What is capital? And this leads him to define capitalism itself in a very specific way.
Yeah, he says, that form of economic organization in which the goods necessary for new production are withdrawn from their settled place in the circular flow, but the intervention of purchasing power created ad hoc is the capitalist economy.
So capitalism is the system defined by this credit-fueled disruption mechanism.
Fundamentally.
Yeah.
And central to this is throwing out the old definition of capital. He says capital is not a category of goods, not tools, not materials, not land.
Why not? Those seem like capital.
From the entrepreneur's perspective, they're all just inputs, things you buy with money to make something else. Labor, land, machines, they're on the same level, technically speaking. If capital was just the sum of these goods, the concept wouldn't add anything.
So capital has to be something different from the goods themselves.
Right. Schumpeter insists capital confronts the world of goods. You invest capital in goods. Capital procures goods. It has a prior, distinct function.
What's the function of the goods then?
Technical production. The machine makes widgets. The land grows crops. The function of capital is purely financial. It's the lever that gives the entrepreneur control over those goods. It's the bridge.
The third agent, he calls it, standing between the entrepreneur and the goods needed for production.
Exactly. It doesn't directly produce anything itself. Its job is done before the technical production starts. It's about gaining control.
This is really important for listeners, I think. When we casually talk about a factory as capital,
Schumpeter would say, no, that factory's produced means of production. Capital, in his strict sense, was the financial power used to acquire the resources to build that factory.
so capital exists before the physical assets are bought.
Precisely. Think about it.
Mhm.
The entrepreneur gets the loan, the credit. At that moment, they have the capital, a fund of purchasing power. They haven't bought this deal yet, haven't hired the workers. The capital is clearly separate. Its sole purpose is payment control.
Okay, this leads to maybe the trickiest part, the dissolution of capital. He says once the entrepreneur buys the stuff they need, the capital is surrendered and dissolved into incomes. Let's walk through that.
Right. Imagine the entrepreneur gets that $1 million credit line. That's the capital fund.
Got it.
They then spend that million. They pay wages, pay rent, pay suppliers for materials.
So the money moves from the entrepreneur's account to the workers, landlords, suppliers' accounts?
Exactly. The original $1 million fund, as a distinct entity under the entrepreneur's control, vanishes. It's been dissolved into the incomes of others.
And what does the entrepreneur have left?
They have the things they bought.
Yeah.
The labor services for a period, the lease, the raw materials. These are productive inputs now, not capital in the Schumpeterian sense.
Wow. So capital's lifespan is incredibly brief in this model.
It exists just long enough to do its job. Transfer control of resources. Then, poof, it's gone, financially speaking.
Leaving the entrepreneur with the assets and the task of actually innovating?
It's temporary, functional, almost like a phantom limb of finance. Now, Schumpeter admits a business person might call their factory capital later.
Yeah, in accounting terms.
But that's just shorthand for assets acquired with capital or potential source of future funds if sold. For analyzing the process of development, the distinction is vital.
So the final sharp definition emerges. Capital is that fund of purchasing power.
Yes, and it's specifically a concept tied to development. There's nothing like it in the smooth circular flow. It's the lever.
Only the means of payment performing that specific function of transferring control to the entrepreneur is capital.
And that's why he concludes there's only private capital in this sense, no social capital. It's an individual's tool for disrupting the status quo, for commandeering resources via finance. It's the bridge from equilibrium to innovation.
Right, we've established the need for this created credit, but wait a minute. If you inject new purchasing power into an economy where resources are already fully used, doesn't that just cause inflation? New money chasing the same amount of goods and services, prices have to go up.
It absolutely does cause an inflationary effect, yes. Schumpeter is upfront about that, but he argues it's a necessary, temporary, and controlled effect, a means to an end.
How does it work?
When the entrepreneur gets that new credit and starts bidding for, say, specialized labor or specific materials, the price of those productive services gets pushed up.
Okay.
And that price rise is precisely the mechanism that pulls those resources away from their previous uses. The old users can no longer afford them at the new higher price.
So the entrepreneur's new money outbids the existing economy. This is the compression you mentioned.
Exactly. The existing producers, operating in the circular flow, suddenly find their costs rising. Their own purchasing power is effectively compressed or reduced relative to the cost of inputs.
Which allows the entrepreneur to grab the resources. Schumpeter credits von Mises for a term here, right?
Yes. Forced saving erzwungen sparen. It's a perfect description.
But hold on. If I'm that baker and my costs go up because the innovator is hiring away my workers or bidding up flour prices, my profits shrink, maybe I have to raise prices for my customers. That sounds like Straightforward, painful inflation. How is that good?
That's the crucial question. In the short run, yes, the existing players are squeezed. Space is made for the new thing, partly at the expense of the old. But Schumpeter insists the process doesn't stop there. That's the difference.
Okay, how is it different from, say, a government just printing money to fund spending? That causes lasting inflation.
In that consumptive credit case, the resources bought with the new money are just consumed. They disappear. The new money stays in circulation permanently, pushing up the overall price level. You need separate action like taxes or deflation to fix it.
But with entrepreneurial credit,
The process must go further, via impressa, by its own internal logic. The entrepreneur has two obligations. One is legal, repay the bank the money. The second is economic. They must repay commodities back into the economy. They must successfully produce and sell the new goods or services, effectively replacing the resources they initially withdrew.
the compensation part.
This is fundamental. If the innovation works, the entrepreneur floods the market with new products, maybe better, cheaper ones. The total value of these new goods should be greater than the original credit received.
So they enrich the social stream, as he puts it.
Exactly. The new supply of goods more than offsets the initial inflationary pressure caused by creating the credit. The balance between money and goods isn't just restored, it's improved.
And what happens to the original credit money itself?
Critically, when the entrepreneur repays the loan to the bank, the principal plus interest that ad hoc credit money is destroyed. It disappears from the system. This acts as a deflationary force.
Okay, let me trace that. Step 1. Credit creation leads to temporary price rises for inputs, inflationary pressure, forced saving. Step 2. Resources get reallocated. Step 3. Successful innovation creates new goods, value credit. Step 4. Loan repayment destroys the initial credit, deflationary pressure.
You've got it. The net effect, if successful, is more goods and services overall, and the initial monetary disturbance is canceled out, even reversed.
So Schumpeter can claim it's not really credit inflation in the damaging sense.
Right. He says maybe even deflation is a better word for the net monetary effect. But he settles on calling the initial phase a non-synchronous appearance of purchasing power and of the commodities corresponding to it, which temporarily produces the semblance of inflation.
The lag is key. Money now, goods later. The gap causes the squeeze.
Precisely. But this neat model assumes things happen relatively quickly. What about big projects that take years?
Yeah, you can't repay a short-term loan immediately if you're building a railroad.
Schumpeter acknowledges this. He suggests that when banks continually roll over short-term loans for long projects, it's not really extending the original credit function. Economically, it's more like a periodic presentation for audit.
The bank keeps checking. Is this venture still on track? Is the future compensation still likely?
Exactly. And there's another mechanism, too. How this created credit eventually gets replaced by real savings.
Through things like selling shares or bonds.
Yes. The entrepreneur eventually converts the bank debt into long-term capital by selling securities to the public, who buy them out of their existing savings. He calls this the resorption by the community savings.
So the initial disruptive bank credit gets swapped out for more stable, long-term funding from the circular flow itself once the innovation starts proving itself.
Right. The financial system absorbs the shock, integrates the new venture, and the temporary credit that started it all can finally disappear. The turbulence gets smoothed out.
This whole process, creating credit, funding innovation, necessitates another key piece of the capitalist machinery, according to Schumpeter. Alongside markets for goods and labor, you need
The money market. He sees it as the essential third market,
And he gives it quite a grand title.
the headquarters of the capitalist system from which orders go out to its individual divisions.
It's where present buying power is traded against future buying power.
In a static economy, maybe it's just about clearing payments or routine lending of existing savings. Pretty boring.
But in a developing economy, its core function becomes financing innovation. It's where the potential future value of new ideas gets weighed against the cost and risk.
Which makes it incredibly sensitive.
Highly volatile. Every plan, every expectation, every fear about the future across the whole economy hits the money market. Schumpeter felt the short-term interest rate, especially, was like a real-time barometer of the entire economic situation. Okay, if this market is so central, and banks have this power to create credit ad hoc, we have to ask the big question: what stops them? What prevents runaway inflation? What are the limits on this power?
It's a critical question. Schumpeter points to both practical and more fundamental limits. Historically, The main practical break was the gold standard.
How did that work?
If banks created too much credit, prices would rise domestically. This made the currency less attractive internationally, leading to gold flowing out of the country. More importantly, people domestically could demand redemption of banknotes or deposits into gold.
And if too many people demand gold at once?
The bank risks insolvency. It can't meet the claims. So the need to maintain redeemability, to maintain solvency, forced banks to be cautious. They had to ensure any credit creation was likely to be temporary and matched by future production.
So the gold standard acted as an external discipline?
A very real one. But Schumpeter argues there's a more fundamental limit, one that exists even without gold, like with today's fiat currencies.
Wait, what?
It goes back to the core condition. The inflation must be temporary. The credit must be self-liquidating through the success of the venture it finances.
Okay, but what enforces that condition?
The bank's own self-interest. Survival.
Uh-huh.
Look, a bank only stays in business if its loans are repaid. And in the case of entrepreneurial credit, repayment ultimately relies on the entrepreneur succeeding, producing and selling those new goods at a profit.
So if the bank funds a JUD, a failed innovation,
It suffers a loss. That loss eats into the bank's own capital, weakening it, making it harder to operate. So banks are strongly incentivized to only fund ventures they believe will actually succeed and generate the value needed to repay the loan plus interest.
so the ultimate limit isn't gold, it's the projected success of the innovation itself.
In a way, yes. Success guarantees the maintenance of the limit. The bank is essentially betting on future productivity judged at today's prices. If that productivity fails to materialize, the bank pays the price, and the system suffers from the uncompensated credit injection.
It's like the bank holds a mortgage on the entrepreneur's future success.
That's a good way to put it. Failure means the bank is left holding bad debt, and the economy is left with purchasing power that wasn't matched by new goods.
Now, Schumpeter does add an important warning, doesn't he, about the potential for banks to abuse this power.
He does. He acknowledges a dangerous exception. If banks are freed from the obligation to redeem their liabilities, say, by government action stopping convertibility, and they start pumping credit into the system for non-productive reasons,
Like what?
like propping up failing businesses in the circular flow, covering past losses, or just funding consumption,
Then you get real trouble.
then you get persistent damaging inflation. Because that credit isn't tied to any future compensating flow of new goods. It's just diluting the value of existing money. But Schumpeter is very clear. That scenario, that misuse of power, has nothing to do with our case.
His case being the specific financing of new combinations intended to be profitable and self-liquidating.
Exactly. The power of banks in his dynamic model is fundamentally tied to and limited by the real-world success of the innovations they fund.
It's a crucial distinction. He gives banks a vital, almost heroic role in enabling progress, but emphasizes that this role is contingent on backing successful disruption, not just printing money indiscriminately. #outro.
Well, that was quite a dive into the financial engine room of Schumpeter's dynamic economy. It really turns the conventional view of money and capital on its head.
Absolutely. Money and credit aren't passive veils. They are the active ingredients, the fuel needed for creative destruction. Without this ability to create purchasing power specifically for innovation.
And to temporarily force the system to yield resources.
Schumpeter argues development, at least in a private exchange economy, just couldn't happen.
Credit is that lever of control, that fiction of a claim that lets the entrepreneur get started. And capital is just that initial fund of purchasing power, gone once it's done its job. It really makes you think. Which brings us to a couple of key questions for you, the listener, to chew on. First, can major innovation really happen without some kind of financial disruption? Does development always require that initial forced saving phase?
And second, what does this theory tell us about the power dynamics in a capitalist economy? Banks aren't just holding our savings, they're deciding which visions of the future get funded.
They're the gatekeepers. Their power isn't unlimited, as Schumpeter shows, it's tied to entrepreneurial success, but they are undeniably the financial architects shaping what's next.
Now, everything we talked about today, the credit creation, the compression, the limits, it all hinges on one crucial assumption.
That the entrepreneur actually succeeds.
Right, and success needs a reward. Which brings us perfectly to our next deep dive.
Next time, we tackle Chapter 4, Entrepreneurial Profit. We'll explore why Schumpeter sees profit not as a return to capital or land or labor in the usual sense, but as a unique, temporary reward.
The prize for successfully disrupting the equilibrium and creating new value. It's the necessary incentive that makes this whole dynamic cycle work.
So we'll look at profit as that fleeting gain that compensates for the risk and the initial disruption, allowing the process to repeat.
Join us next time as we explore the nature of pure entrepreneurial profit. Thanks for taking this deep dive with us.